All right, so we're back at the dashboard. We have our three accounts here, a respective feed set up, and we're waiting on PayPal to start streaming in its data. Now it's time to turn our attention towards what's called the conversion balance. So when you started setting up Xero, you set a date that you, and I believe it's a month and a year, that you wanted to begin processing transactions within Xero. And if you're not quite sure what that date is, you can go to Settings at the top, then to General Settings, and the third option here is Conversion Balances. Once you click that, what you're going to see is it's going to ask you, well, what were your balances as of December 31, 2014? And what that means is it's asking you what were the balances on all your accounts as of the day before you started working in Xero. So if this says December 31, 2014, that means I set my conversion date as of January 2015, so the beginning of the year. And that's actually generally what I recommend for most people is, if at all possible, try to start at the beginning of the year. So even if you set up your business mid-year, what I recommend, start this, it'll make it a lot simpler for you if you just start this at the beginning of the year and then leave everything as Xero. And then further along, we're going to be able to import data and get all your accounts, the amounts perfectly current. So anyhow, my general recommendation is start at the beginning of the year and work through that. Let's say you have an accounting software that is current through the middle of the year. Well, then it might make a lot more sense to set the conversion date as of the month after your most current accounting data. So, for example, let's say the month of June was the last month that your accounting data was correct in your previous accounting software. Well, then I would put July as my conversion date in Xero. But if you're not all that organized, you don't have all your records together, most likely starting from the beginning of the year will make a lot of sense for you. So once we've settled what we want our conversion date to be, the next thing we need to figure out is, well, what were the balances in all our accounts as of the beginning of the year, or as of the conversion date? So hopefully you set a conversion date that's far enough in the past that you can keep all of this Xero, and that'll make your life simpler. But let's say if your business is a few years old and you do have some balances in your accounts as of the beginning of this year, and then you're going to have to go ahead and plug these in. So let's say your business started late last year. We're currently, at the time of this recording, we're in 2015. So let's say we need to figure out, well, what were your balances as at the beginning of 2015 or the end of 2014? So what I've done is just got a couple of statements. The times, the dating of these statements is obviously going to be off. I just went and grabbed the most recent one from some accounts. And essentially, for you, you're going to go plug in. So for the checking account, I need to go pull the December 2014 statement. Let's assume this is that. And so what we're going to do is, well, what was all of these statements give us a beginning and ending balance. So we need to go grab the ending balance on the statement if you're pulling the December statement. If you pull a January statement, then obviously you want to pick the beginning balance. But we're going to go grab that number. I'm going to go plug it in over here, 603.44. And one thing that's important is the checking account needs to be on, if there's a positive amount, if you have a positive balance, you're not overdrafted, you need to put in the debit column. If you were overdrafted, well, then in that case, you need to put it in the credit column. But bank accounts, the normal balance goes in the debit side. For credit card accounts, the normal balance goes on the credit side. So now that we've got our checking account, that's how you're going to plug that. You're going to just totally take the number from the statement, plug it straight into the conversion table. I've also got a credit card statement. And your situation, there's so many different situations you could be in. I can't obviously cover them all here, but one pretty common thing is that most credit card statements go from the middle of one month to the middle of another month. For example, the 10th of August to the 9th of September. So if you're trying to figure out the balance on your credit card at the end of a particular month, generally you're going to have to do some maneuvering. So you'll either start with the beginning balance and then add in the charges that happen between the beginning date and the end of the month. So if I were going to start trying to figure out, well, what was the balance at the end of August, I would start with my August 10th date and then plug in everything that happens between August 10th and the end of August. The other option, if the closing date is closer, you might start with the ending balance. So the September 9th, that this statement ends at September 9th, we'll take the September 9th balance and then we'll back out all the stuff that happens between the 1st of September and the 9th of September. That's your two options. Obviously, the numbers are going to be a lot different for you, but however it works for you, you're going to need to do some calculation, and I'm just going to steal this. Let's assume I don't need to do any calculation. What I'm going to end up doing is plugging in this balance on the credit column for my credit card. So now we've plugged in, I have this much in my bank account, I have this much in owed on my credit card as of the conversion date. And now what you're going to notice is there is a balance. The debits and the credits don't add up. And without going into too much theory, essentially that is going to be caused by a couple of different things. So what happens is you're essentially going to either leave this as it is, which I don't recommend you doing that, or you're going to end up clicking show all accounts, and you're going to end up plugging that balance into one of a few different places. So I'm going to go ahead and grab this 1604.28. You really have a couple of different options. The first option is I'm going to look up owner contributions and distributions. This is money you've paid into the business or money you've taken out. If you have more liabilities than assets, so your credit card balance is higher than your bank account balance, well then I would probably put the balance into owner distributions. Maybe your business has been running a while, and so the other option is if you have more liabilities than you have assets, then chances are your retained earnings, as in the net total income your business had generated up to that point, you can plug it in there. So those are kind of your options. Plug in the balance into retained earnings, or plug the balance into owner contributions or owner distributions. So that's your option. If you get hung up here, I don't want you to get too overwhelmed by this. This is definitely one of the more complex concepts in terms of setting up your accounting system. Don't get too carried away with this. If you get stuck, that's not a problem. There should be some support. I'll be here to support you. As of this recording, I'm currently offering support as part of the purchase price of this training. So you should be able to reach out if you get stuck here. But anyways, this is how the conversion balance works. Go ahead and plug in your balances as of the conversion date, and then we'll be ready to move forward.